Hello, Legends Alpha Capital community. How you doing? Weekly preview, 18th of March, 24. So we got through Cheltenham and all the pies, and this week it's the talking heads chatting amongst themselves, and we're finally going to get a bit of direction after what's been a decent month overall of the US data, rolling back the worries on the out of control data and inflation going nuts. Obviously, in the last week, we've had a little bit of pushback. We thought the dollar would trade up in nervousness. It's just whether we got through those prints okay. Now, to me, the headlines were bad, and everyone's jumping on that, and the rate of growth of PPI and blah, blah. Remember, I've said CPI minus PPI is good for profits. If you look at the headline level, then there's a little bit of worry. So that's probably what's just making sure that there's a bit of nervousness still in the indices. But when we looked at it under the hood, for months now, people have been going on about the unbreakable rents not coming through, as slowing down in CPI, despite what the Atlanta Fed was showing and the market at large. So we finally get a print and no one talks about it. And all they can concentrate on is auto insurance. And I don't know about you, but I buy my auto insurance once a year per car. And health insurance, I buy that once a year. So the fact these things are running high and there is an investigation going on in Washington by the politicians, that's something that could quickly unwind, and that is really what's causing the flow through. Plus eggs. No one likes an egg more than me, but let's be serious. Is that really going to bring an economy crashing down and cause rates to go up? I don't think so. So things look on the face of it a little bit stickier. So a natural reaction has been for the markets to push against the rate hikes. So we go into FOMC this week, slightly perturbed, slightly worried that some of these more hawkish talking heads may get control. So of the 19 people that are involved, only 2 of them need to move more hawkishly on their dot plot. So each person on the FOMC puts their own little chart together when they think the rate cuts are coming, how big and when. So if they push back later in the year, that would move us to these 2 cuts. Now, I think it's in the narrative. People are chatting about it. We are set up hawkishly. And to me, I'd be very surprised if they did move that. Equally, there's an inflation projection to come from the Fed. They've said they need to see more data about cutting. I think they need to see more data about talking about higher inflation. Or this could just be a couple of months. Everyone's saying, would it be a 1 month outlier? But there's all seasonality working through. And as we've said, some oddities within the data. Surely they want to see more. So I'm leaning towards the fact that we have nervousness going into the middle of the week. Nothing actually changes. There's no rate cut. There's no change to projections. And there is no dot plot net change. And then we resume back on the dollar selling off the rally. I know there's been 1 or 2 people out there banging the table saying how much they told you so. The dollar is strong and it's going up. But we said it was going to be strong to top out a consolidation leg and then come off again. I still think that's what the setup is for the dollar. Hopefully had a bit of fun with that Cheltenham ACG Macro Challenge Hurdle, and we talked about the 4-way photo finish. Growth trumps everything. Inflation sticky. Are we due a pullback? Rate cuts in June, all in a line. What we didn't notice was out the back of our eyes, coming home like a steam train, was probably stagflation, China's deflation. China's in a deflation hole, and it was July all along. And we'll have a look at a few of the CME Tool charts showing you where the market is projecting the interest rates to come in the States. And it is important to look at the detail, because it's too easy to look at the total percentages and how they've moved. We need to see exactly what's moved, and really not a lot's actually changed on the overall countback. And I'll explain what the CME tool is when we get there. So we managed to get through Friday. That was the Ides of March, the 15th of March. Scholars out there know that's all about Julius Caesar's betrayal. Normally, people are a bit worried in the market about doing anything. And it was, I mentioned it late on the chats, it was triple witching on Friday too. That's when all the stock, index, options and futures all come to maturity. People either roll over into next time period of contracts or they expires. And what normally happens is that the traders and the market makers are left with really important underovers, positions at certain levels. And that's why you need to ignore the trading, really. It's quite a high volume for of late, but everyone knows it was tied up with triple witching and attacking and defending certain levels. Using it within your charts to make a decision, it's probably a misnomer, but I don't like saying ignore things, but certainly add less weight to whatever happened on Friday. So again, not really heard much from the talking heads because they've been in lockdown from the US. It's been rather nice, hasn't it, not to hear from the Trumpton lot. Let's see what they've got to say when it really matters. Starting off the week will be the Bank of Japan. We've had lots of commentary on that. It's gone pretty much the way that we thought it would, and what we've highlighted. Rengo put in such a high wage negotiation, knowing that they're going to get knocked back about 0.75%, and they managed to get, for the largest union, above 5%. Expectation as a whole was for 4.1% wage inflation. This is a real proper result. Should start making people relieved they really can embed inflation, wages, leading to sticky prices, leading to not having to put the rate cuts up and take them back down again. And that is a big fear of Japan, and probably why they've not gone and why people are nervous about them even starting. It's all these false starts that have gone before. But that wage negotiation, one of the best for 30 years. So things really are moving apace. Ueda has said that he would continue buying Japanese government bonds, but I've noticed there's a few hedge funds being very vocal how they're taking those on. But we're more interested in how it will affect the indices and the yen. Now, to me, I've talked about the fact that to attract the overseas investment, you want a strong yen, and that is probably going to happen in the medium term. We've got money coming back from that, reversal of carry trade. The domestic investors and retail investors haven't been investing this year locally. What would you invest in? A bit like the mid 250 in the UK, you would look at the topics, which is domestic stocks, and within the Nikkei, all the things that Buffett has talked about, the banks and insurers, they're the things that aren't really affected by any exchange rate movements. And they're set to go banzai, as it were. So I think we're going to get another leg up in the Nikkei 225 when this all settles down. You go into the banks because if the rate's going up, interest margins go up. Insurers make money out of their investment income, blah, 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 all feeds in, becomes quite self-fulfilling. So I can't see the point now that all the boxes are ticked in them not going in March rather than April. It will definitely happen in April. But as the market is telling you next week, or this week as it is now, is going to be the time to move for Japan. Royal Bank of Australia, or Reserve Bank of Australia, sorry, they're not expected to move at all. They've come off their hawkish tone. They're going to have a look at that, I think. And the people I've listened to have said that once they do move, they'll be aggressive. That's the typical Aussie way. It's a bit like Shane Warne. He never used to mess around with the googly, the wrong un, as it were, because his ordinary game was so much better than everyone else. He didn't need to. The Aussies are generally in your face. What they say is what they mean. The old WYSIWYG. And we'll wait for them to start moving, but I don't think it's this week, so it's nothing done. So I talked about the dot plot for the FOMC. We don't want it to move away from the 3 cuts for the year. Now, we've got to be careful here. They need to start moving soon because they're supposed to be independent. They've said outwardly they're independent, not political. But the meetings fall funny this year. The election is on Tuesday, the 5th of November. The November meeting is on the 7th, and that's actually going to be a Thursday because of that Tuesday election. The 2-day meeting will take place afterwards. So we normally hear from them on a Wednesday night. It will be Thursday in November. They may well go with the politics out of the way by then, but what it certainly means is the previous meeting to that is September, and there's no way in the world, surely, that they're going to make a move on that. So that leaves us effectively with May, June and July to start this rate cut moves. May's probably too early. March is definitely done, isn't it? June and July, it's between those, and we'll have a look at that in a minute. Boom, boom, boom. I said they're watching the data. It moves both ways. What will happen? So CME Tool, this is effectively, when you hear people talk about percentages for rate moves, they're built up by whichever respective country's short-term interest rate futures are involved. And what it is, it's 100 minus whatever the expectation of the rate is going to be at any point in time, gives you the price. So 100 take away 5% would give you a price of 95, for instance. So what these guys do is look across all the contracts and all the maturities, and they build up a model for you, so you don't have to do it yourself and keep putting the inputs in. So if we look at the 18th of December meeting here, the midpoint is 450 to 475 bips as being the favourite on 34.3. What you do is add in all those below that. That tells you that plus another 23% and 6%, so 65% effectively of there being 75 basis points plus off the rate by the end of the year. That's still 2-1 on as a favourite, despite the fact people are saying there's going to be no rate cuts. And as you work back between these, and they very helpfully give you what it was like a week ago and a month ago, and that's where we see a lot of the movement. So if we drop down these and have a look through these, come back to me with any questions that you've got. But we're really interested in this June meeting because that's where all the focus is on really for the dot plot. And so what's happened over the last week with this slight uptick in CPI and PPI, etc. So we currently sat on there being 55% of people expecting a 25 bips cut and 3.6 still expecting a bigger cut than that. So we're up to sort of 59% now. Where were we a week ago? We were on 57.4 for the one cut, but another 16% more. So it was 73%. So it's come in by 18%. But if you think about it, if you look at these numbers, the actual expectation of there being a rate cut in June hasn't moved. What's happened is the bigger cuts have got priced out. So that whole 15% has come down to 3% for there being more than 50 basis points of rate cuts by June. And that's got added on effectively straight through to there being no change at all, which was on 26 a week ago, and it's now up to 41. So you've got to be careful with how people are explaining that to you because it's, we've dropped from 75% down to 59%. It's much less likely, but it's actually the periphery that's moved, and that's cascaded through to more from there being bigger cuts into there being no cut, but the actual median mode average expectation is still for there to be a rate cut in June. And that's something to keep an eye on. But that's the classic lies, damn lies, and statistics. People will tell you what they want you to hear, but we, as ever at Alpha, we look at the details, don't we? So to me, that's an interesting tool. CME dot, I've got it here. Have a look. CMEgroup.com. Have a look at that. The only one they give for free is the Fed tool. It's an important one. I think they do sell the ones locally. So you get a mixture to find out interest rates and where they're going. You either do these short-term interest rate futures, or you look at the swap rates at each maturity in the marketplace, and that gives you a read-through effective yield. You can find those on products like Trading Views. You don't necessarily have to subscribe to any of the news information services, but it all depends on how far you want to go. Bank of England, Thursday, again, not expected to do much. They have had positives. The wages were much better, despite the fact the headlines only moved slightly. People who looked under the hood are saying, the 3 and 6 month rate of wage changes are really ratcheting down. The trend is in the right way. And some of the forward-looking data on production are telling you that that recession was like we talked about during the week on how the read-through for GDP on the monthly basis was back in positive territory. So that, takes a little bit of pressure off. We're not absolutely collapsing. We're not seeing stagflation. Trends are moving, but it's too early for them to move. There are only two dissenters, Haskell and Mann. Mann's the nutter woman, knitting needle lady. You absolutely criticise anyone for going out, entertainment, having a drink, bar humbug, getting knitting out of one stitch or two. She's not going to move. Nothing will move her. She was out last week talking about a tight labour market, and we're still a million miles away from being able to cut rates. She's obviously one of these that needs to see it at 2% before she advocates a rate cut. Haskell's more wavering. He'll listen to the chattering around him, and he'll probably come back into the pack. We still need, we've got a lot of mortgages rolling off towards the end of the year. The retail space, as well as there being lots and lots of rollover debt, the UK is exposed to that. That needs to see the base rate. We'll talk about this when we're doing more macro, but interest rates matter because when you're pricing loans for companies and individuals, it's all based off what that first government level interest rate is, and then you allocate risk based on a premium and an extra yield on that. So say a government's trading at 4.5%, and you're a fairly non-risky company, you'd add on 100 basis points, say, and if you're really risky, they'd probably double that to 9%. So it's important we get the base level of rates as low as we can. Something I want to talk about, gold. The gold situation. I've got a few things that are quite instructive from a personal point of view that might help you think about the mindset of top-down macro and bottom-up fundamentals, how to bring them together, and I'll show you on something that I've been involved with and I'm actually an investor in. So yet again, as normal, we are giving analysis here, not advice, and don't rely on it to make any money, but rely on the advice, the analysis to be quality. It's just, if you make a decision, it's all on your own back. So gold beans in China, there's a massive demand from the younger generation for something that holds its value. They don't trust their own currency, they don't trust their governments for their policies. So a little bit of scared, as it were, investment in physical stuff. And there's these jars of gold beans going around. There's people quite sensibly saying they don't want to pay more than what the gold price is, but apparently if you build it up, there are better things, better value ways of playing gold as a safety investment. But it's good for a trend. And if you look at where the investment has been on the buy side in gold, the demand has come from India, which it normally does after the Lunar New Year in China. Very high seasonal purchasing, but also the central bank of China has been the largest buyer. And that is something quite instructive. And we'll look at the relationships between gold and the central banks in a short while. But what was I saying there? Yeah, so we'll talk about that now. The central banks are basically buying. We talked about how some have made it legal to be able to trade around in it. Russia isn't getting enough oil money in. They're going to have to start trading it soon. And people are very worried about the fiat currencies. They're worried through Bitcoin. They're worried the way that the Fed's debt's going to go up to 45 trillion in the next couple of years, which is, at least double what their GDP is. It's all totally out of control. Banks are realizing that their reserve ratios in percentage of gold is too low, and it's going to become an effective trading currency going forward, as well as something that you can pay your debts with. If anyone wants to ask for the playbook on this, go and speak to Gordon Brown. He managed to sell all our gold at the bottom in 2008 and took on all the overvalued subprime mortgages. Proper player. Why did I vote him in? Not a political broadcast. So there's another thing at work. Also, I've said before, we're in a super cycle, and there's a lot of rumours that geologists aren't getting paid enough, and they can go make more money in other areas using their skills. So it's becoming harder and harder to get supply online in the gold industry. So you've got demand going through the roof and supply imbalanced. What happens then? Then you get big spike ups in metals. And I think we've got a long way to go in gold and various other commodities that are in a similar supply-demand imbalance. So why does that lead me into top-down, top-ranking musical youth, bottom-up fundamentals? Well, when everything aligns and you can see a tick box on your macro side, on your micro side, and then you can find something that is mispriced, then you should be going balls deep, get every bit of money you've got in the piggy bank and start investing. So I've mentioned a few times recently that I've been looking at a gold stock, and that gold stock is Fulcrum Metal, and I am now an investor in that, so take that into consideration. But what I'm about to show you is, the way that you should be thinking in general about stuff that you are trading in general. So look at this chart, and you've got uranium and spiking massively here, and you've got gold up 20%, you've got uranium up 88%, and then you've also got the two relative ETFs, the junior miners, because Fulcrum's a junior, what they call a junior miner, it's a sort of exploratory stage, and then you've got a uranium ETF here in purple. Now, both the gold and uranium ETFs as a way of trying to play strong macro fundamentals. You get a lot of underperformance, and it does depend on the flows within those funds, and also you're exposed to positive and negative performance from the underlying. So if you want to really try and find or have time or some way of finding some good research on companies that are mispriced or that have really good assets, and Fulcrum seems to be one. And if you look, basing back to when Fulcrum came to market, they're actually down 15%. They're stock full of gold, very clever position, gold fields or opportunities and assets. They've got uranium fields. Every bit of news that they brought out has been positive, and yet their stock is down. They've got really tight shareholder structure, which means that it's not that many shares in issue, and they are in hands that don't want to sell them. Whereas when they're in the AIM market, the small cap end of the FTSE, despite the fact that they trade in Canada, they're giving the UK investor a chance to be involved. So they're in a really safe jurisdiction. And then they've also got this asset, which is to do with tailings and cleaning up the slop, the waste from all the mining operations, which have caused some big environmental disasters, and is something that is really holding back permissionings on new supply for gold and uranium. The uranium is important for electricity production. That's why people want it, and everyone's going back to nuclear. So again, there's a deficiency, and within uranium supply, a lot of it has come from demilitarization. While we've been in this, quiet period, the post-Cold War, everyone was degrading their weapons, and this was being used to upgrade the quality of uranium. Well, now obviously we've got geopolitics everywhere, wars left, right, and centre, and Russia pseudo threatening a nuclear war. And I don't imagine there's going to be much demilitarized uranium on board anymore. So it's really important you can find supply. So the fundamentals of that company are totally ridiculous. The values of them are way in advance of the market cap of that stock, and yet every asset that they trade in is through the roof. So that is a massive disconnect, which is why I'd say that is when you're looking, you've got a top-down reason to buy it, you've got a bottom-up reason to buy it, and there's a massive misprice. That's why we're here, isn't it? That's what we're looking for. And that tailings, they've got this technology. They're partnered with one of the biggest engineers in the world, Bechtel, who are partnered with Extract, and they're going to have this non-cyanide technology for separating the tailings, so lots of little tiny bits of minerals or gold, whatever it would be, and cleaning up the water. So funnily enough, everybody wants to see them. So they are what's known as a disruptor. And you've seen what happens when things like Amazon disrupt, normal online markets, etc. If you can be involved in a disruptor before the prices move, these things go nuts. So that's where the Planty money is. I'm invested in gold, and I'm also invested in Fulcrum metals. I think both of them are going to give me a considerable return. So also within that, if you don't know, Fulcrum is what you pivot around. So when people talk about pivot points, it's literally a point that you're pivoting around, and that point is called a fulcrum. So from now on the charts, when you're talking about fulcrums, keep it in your mind. So where are the markets? I've intimated that we've been held back a little bit of late, but what's the slightly bigger picture? And some people, it's funny because you can put this argument both ways. And some people are saying that productivity, and we've talked about how we've had gains for the last few months in the US, and that is offsetting a lot of the wage inflation situation, because you're getting more bang for the buck as a company. Some are saying that it's only a third of the growth rate it was in the 90s. So where on earth is all this tech capex revolution from AI, blah, blah, blah? Well, that's the whole point, isn't it? We're on the cusp of it. People are only just creating and building out the chips to allow us to do the next stage. So rather than looking at that as a negative, I'd say that tells you how much of the pie is left to come. So it's another reason why we should start believing the projections that these profitable companies are giving us. This isn't a case of everyone jumping on the bandwagon, every third tier tech trying to tell you something is there when it isn't. These are people that are actually in demand with earnings that are growing. And Bloomberg framed it lovely. They're saying, there's a lovely couple of quotes. The shares of AI, darling NVIDIA, at 36 times compared with a multiple of 130 for Cisco in the middle of the dot-com frenzy. Now, I've seen another couple of people out there saying, that rating for NVIDIA is the same as the average, blah, blah. But it might be, if it's the same as the average, we're in the pack situation, aren't we? We're not talking about being at the extremes of what Cisco was. And the guy who back in the day, Jeremy Siegel, who's a finance professor now at the University of Pennsylvania, he was the guy that called the tech share bubble a sucker's bet back in 2000. And this week he was saying that the valuation gap we've got today, there is no bubble. Bubble warnings are overblown. There's a justification for where things are. So I've been saying that for a number of weeks, and it's now getting backed up by the people who really know what they're talking about. And again, how do markets work? Something a couple of you have asked me about is the BFTP rescue fund being withdrawn, and I've seen that being part. It's a real negative. That's liquidity drawn out of the system, but it wasn't meant to be punting money, was it? It was a 1-year situation to find liquidity for post a bank going bust, banks not being able to trade off the back of the assets that they had. They were all mega undervalued. So what the Fed did was say, right, you can lend those assets to us and we'll give you 100% maturity up front, but you've got a year to pay us back. So by the sounds of it, some people have been borrowing that Fed money forward to try and make a quick buck. They may well have succeeded, but the Fed have spotted it and they've said, right, we're not extending that 1 year of grace. And as they said in the testimony just a week ago, they don't think there's any systemic risk in the system. They'll let people go bust who aren't in the right position, but they're not systemic. They're not going to bring the system down. And Mnuchin is getting all his buddies together week by week to sort out the problems. And he's gone in there to sort out NYCB. So, I'm quite comfortable with that. You only worry if it's systemic. And I said in the thing, you only worry if it's systemic if you're not taking away toys from the naughty corner. It's like, boys, behave. You're in the naughty corner for a reason. But PEs, I talked about PEs, that's price divided by earnings. If that ratio is indeed something that people think is justified and your earnings have just shot up, then the price needs to adjust to keep that ratio the same. So what we're talking about there, 25 on the earnings and the PE is trading on 30 times, that's 750, right? So if it goes up to 30, you need 25 times. Sorry, let's start again. So if we're on so we're having a catch up in ratings with the PE, price divided by earnings. And if we're saying that the earnings are on 28 and they go up to 30, they're going up by 5%, then you need the numerator, the one that's on top of that equation, to go up to keep that ratio in balance. So that's what's going on here. The markets are rallying justifiably to stay in line with the rating. And as I pointed out at the time of NVIDIA, the ratings for years out, and we're now moving from this year into 25, for what people are going to be making those ratios on. If those numbers are going through the roof, you're derating if you don't move the price up. So it's quite rational to see the indices acting like they are. Japan, again, they've had more earnings upgrades than anywhere else in the world, and the Nikkei has gone through the roof. It's all justifiable. It's not a bubble. It's keeping things in line. I've got a chart later on credit spreads. Now, quite justifiably, people are saying that, these things are now so tight. Isn't that being complacent? Well, if people aren't at risk necessarily of going bust, then why should they have high credit spread? So that basically, it's again, how much do you need to pay for protection subject to your riskiness? So if you're not risky, there'll be fewer basis points to have to pay above what the prevailing bond prices that we talked about earlier. That's why we need to get, whatever the bond price is, your company pays a risk-weighted extra amount of yield. Now, the fact that they are trading as close to the best credit as they normally are when things turn around doesn't mean that it's a definite sign that things are about to crash. We'll look at a chart. So they're in line there, but I think that is, again, quite justifiably for the fact that there's no problem in the system and money's being created, and the financials aren't at risk as what everyone says they are. So yeah, we can identify some of these pullbacks, and we're seeing with the effect of the nesting that we've had in gold and in the NASDAQ and the S&P, blah, blah, and Germany, that's really doing something special at the moment. You know, these things are telling you that those particular areas have bottomed, and it's all well and good trading and timing the market. Now, if we're scalping around and blah blah, you might not be that bothered. But if you're trying to play swings or change your investment style, if you're making money, if you want to invest it and put it into clever things like the Fulcrum that we mentioned above, then you need to know and you need to be involved, because you can't timing when the moves come and when the news flow comes out in those situations is difficult. You might be an absolute god, totally timed it just before it crashes 10%, take a couple of days off, something happens, you haven't got back in the market, all of a sudden it's up 20%, and you're now down a net 10% for not having stayed in. And what we said about last week, that won't just be 10%. These things have a habit of going up 100, 200% and pulling back 10s, 25% if you get a crash. Over time, that's how you compound your money, by being in the right areas. There's a brilliant thing on LinkedIn, I forgot the name of the company, but they do all these things which show you the growth and moving around of stuff over like a 20-year period. Sometimes it's things like internet providers and things like that. And there was one last week, what if you invested $1,000 in 20 years ago in a number of these companies, how do you have got on? And they're all to and fro, and Apple was up and down and all over the place, and Nvidia had a spike and then disappeared. And then by the time you'd finished, apart from Monster power drinks, Apple had gone up 500 times. So, you made 500 times your money over those 20 years. But there's been plenty of occasions when you'd be listening to all the media and running for your life and probably missing out. But obviously, we are going to be due a pause. Anything that could make that happen? Well, I said we've got the US elections coming into sight. We've got a lot of nationalism all over the place. China telling their EV guys to source locally. We've got the US getting ready to be a little bit more nationalistic, mercantilistic. Mercantilism is another way of describing that. And that's when you're looking after, number one, keeping stuff at home, making it difficult for imports. Now, that's Trump's central policy. He is the Oompa Loompa daddy boy of that. But Biden's a little bit protectionist as well. The US are currently trying to get TSMC, the big chip manufacturer, to make a plant in the US to avoid anything going wrong with China invading, blah, blah, blah. And net, this is all going to cause a little bit of dollar strength. If you're taking away the import side of your economy, then you're not having to sell your currency to buy externally. And that is what Trump particularly wants to do. He wants to get everything going back to domestic economy versus external. And when we talk on the videos, the training videos about markets, of fundamentals and economies, that's a really big part of aggregate demand. I'll show you that is why it's important, and you can tell where you need to be and where you need to see strength to make up for weakness, or where you should be investing, because that's what the politics is suggesting is going to be the trend. So what does that leave us? I've said for a while, then that means we're going to have Q1 and Q2 performance, which is why it's very dangerous to fade at the moment, these indices. And I do think we are now getting set up into 3, 4, 5 situations. We're topping out the 3s. The 4s will be shallow, get other 5s, then shallow 4, 5, 4. It's all going to cascade. I'll show you on the chart later on. Be very careful in the short term about getting too negative. The dollar really should be topping out again. We've been going on about it. It does look like it's going to play that way. People, again, will want to try and make their money in Q2 with their emerging market plays. It should all come together. Lots of people talking about 7 trillion of debt that needs rolling over for companies. Again, that's why we need to get the rate cuts going, keep inflation low. It is a balance, but I think we'll get through that. We've seen the demand in general for the government's debt has been okay. If there were real worries about being able to place the maturing of the corporate debt, then you would not have high yield spreads as tight as they are, which the thing we just discussed. And we've still got $6 to $8 trillion dollars hidden in the money market funds. As soon as the rates are cut, they'll be looking for a home. They'll probably look at risk analyzed corporate debt to get to what they say is walking along the yield curve to earn more money. So don't panic. These things are out there. There's long trusted methods of what to do when the free money, as it were, starts to get less and less. So I mentioned it, they were leading the horse race for quite a long time. Growth trumps everything. Are stocks just ignoring bad news, or are they pricing it in? Net for the last few weeks, it's been suggesting that growth is chugging along and inflation is, the odd spike here and there, but it's not rampant, huge breadth to it. And I think a lot of those things will unwind and continue to unwind. So it then becomes a situation of margins. Do you have pricing power? Have you got inflation in your company? Can you keep your inputs lower? That creates profit margin, creates profits. That's why there's a demand for stocks around. And that showed itself. Be careful of reading too much into individual days, but going into CPI, and we might get something like this going into FOMC, but the single day option VIX, as it were, the implied volatility, the scared index, had gone up to 19, very much the top of its range. And then when the CPI wasn't as bad as what people had feared, it shot down to 11. So that was one of the reasons why the market went up, when people were giving you all the headlines, CPI's through the roof, and yet the markets are up. It's nonsense. Well, it's the fact that a lot of the downside protection was being unwound, plus those figures were suggesting, because they were before PPI, suggesting that, there is a little bit of pricing power in the market, that's profits, and the equity market is looking for any excuse to keep investing at the moment. Oracle was a heavyweight on that day as well, and that helped push things through. So the biggest bearish argument I'm hearing out there, and we'll see it in the charts in a minute, is that there's this ending diagonal taking place. That is a sort of lower momentum, crisscrossy waves. Now, I do think there's every chance that there's one of those in place, but I don't think it's an end of actual wave progression to the top. I think it is going to be the end of this current wave that we're in, but I can see 4s and 5s that I've already got on my charts. I'm not now making this up as an idea. I've been showing you for weeks, and I think that the bears are still looking at they're in the wrong wood. I think it's there's more high to come before we start pausing, and that is going to be the Q2. We're not over the top of the long-term trading ranges. It's hard to call, because what will look like a sharp fall of 5 to 10%, once we get the bigger waves completing, will actually probably be a 38 fib. And that's what you're going to expect for a fourth wave in general. In the bigger picture terms, as a bull, you'll be quite happy. The bears will be jumping up and down, telling you it's the end of the world, and it'll be hard to tell the difference in the short term. But hopefully we'll be prepared for it, and we'll have made all this money riding it up in the first place. At the moment, all these people that are bearish have been absolutely buried, getting chased up. And as I'll show you in a minute, they're coming up with all sorts of nonsense to try and make the charts fit. We mentioned it last week. If they're not careful, it's going to go so far that they're going to have to redraw this as the middle of a different third wave that's got a 4 and a 5 still to come. So that leads me on to some charts. Right, so here we have the dollar, and I said last week I thought we were doing some kind of putting a connector in, and it was all a case of, was this the top, or was this just a connector to have an equal legs to put in for two? It very much looked like it was the latter. Obviously, we had the little spike on Thursday post PPI. Tuesday was the one that confused everybody, because we got that little spike up and then it sold off to put in the connector. So it's quite frustrating, the dollar at the moment, isn't it? You keep getting these, have we topped out? And we've properly in impulsing down, and we did get that into this one low here, but in the detail, the equal legs of this WXY is just a tad a little bit above here, which is at 103.485, and there is a bit of a supply zone there. It's not impossible that we get a throw over on that, but I'm pretty convinced that at the start of this week into the FOMC, we're just going to be topping this out. It's going to be quite well extended. We were talking about consolidation all the way from down here. It was just a case of whether it doubled or not. We've now got people telling us that because this has all happened, that the dollar's bullish. I'd like to think that we were ahead of that game. Our net position is that we're coming off. As long as we're being aware all the time that these things can extend, we keep it sensible. The euro and sterling have been pretty strong against US in the main. And once this US sells off, I think that trend will continue. What worries me medium term is that the EU is probably the one that is going to do the most cuts. So we need to look out for perhaps that'll be the signal mid-year when the dollar reverses. But that's something for another day. I mentioned it earlier, the high yield index, Bank of America, it's on ICE. So it'll always be delayed unless you pay for the ICE feeds, but you don't need it. This is on a weekly basis. It showed you in COVID, everything went nuts up to kind of the 10 level. That'll be 1,000 basis points above treasuries. And then down here, the periods where the market was topping out is when these indexes were low. So it's an easy comparison for people to make. But if anything, this is telling me that we're in a consolidation trend. There's always going to be a three wave. It may well be that we flatten out here. I expect it to come even lower, to be honest, to put in the absolute end. So we're probably in towards the end of that game. You're not going to get a lot more tighter, but certainly no signs. It's a proper downtrend. It's not as if it's just a spike like this was. This is, been building as we've been rising up. Now people can say, yeah, that's natural because that could be the top of the markets. We obviously look like we may have put in at least a three wave at the end here. It looks like we've got a lot of overlapping. So every chance this is a kind of ending diagonal. That's what tends to happen. But generally that will overthrow the trend line before it reverses. Anyway, just something to keep an eye on. That's what people are talking about when you hear them say that credit spreads are too tight. So the Dow, this is the one where they've really been annoying me because, yes, we're talking about an ending diagonal, and that would be a bunch of three waves or five waves and three waves, but they'll overlap. So there is a lot of overlapping going on. We've talked about that lack of that divergence into the highs. Now, the way we've had the chart, the highest MACD divergence normally comes with a third wave, and that has lined up for us here. So you'd expect to get a fifth wave on much lower momentum. We had a bounce off the fourth low, so that was in line with lower lows on both. And then we've been coming up. We've had a high, which I sort of said I could allow for the highest of the waves within this movement to have the highest MACD. Well, that would line up with what would be here. Now, from there, I think we've had a three wave and then a move up, which is what could possibly be an ending point for a five wave, but I think it's very much within the structure and we're still getting sideways movements here. So the way I've seen it is that people have put that in as a third wave, and then this, which hasn't even gone to a new high, has been a truncated fifth. I mean, it's a outside possibility, but it's totally unclean and not seen that often. So I think it's suggesting to me that we're putting in a consolidation wave at the moment before we put in another high here. Even when that has taken place, I expect the pullback to drop into the realms of this third or fourth wave here. So it's not a disaster, and I've been saying it for weeks. I'd like to see a pullback just to calm everything down and consolidate. But to me, if this is a series of three waves, you've got a 1, 2, 3, 1, 2, 3. You're going to get another at least three wave movement up to create a new high here, probably, and quite possibly touching the 40,000 level. You never know. NASDAQ again, that's similar, and within the wave structure of this third primary wave that I've got. And we're down here at some of the minuet and minor levels. These things have got the 3, 4s and 5s. I agree that it's probably some kind of ending diagonal for this third wave in here, but it fits much better here as having a three-wave consolidation for 4 that suggests we've got another high to come in the NASDAQ before that again consolidates back into this fourth wave, another fifth wave. And you can see, I still think we're in this grinding higher lows, higher fourth wave lows until we eventually put in a proper top in Q2. So it is going to be choppy, but we are, I think, going to keep grinding higher. And, this has done exactly what we've talked about. We said it's going to do a 3-wave and challenge the bottom of the channel before it goes again. I'm going to stick to that until it breaks. Germany, absolute powerhouse, as I mentioned earlier. These I've left the arrows in that we were hoping it would manage to cling on to within the bullish channel we'd got. We were talking around here, put in that a final low for that move. Absolutely splendid, 600 points above where we were. Was it 600? No, 300 points above where we're expecting it could possibly go to. So that's just carried on powering with flatline channel upside, little pullback. Now look at this trend line at the bottom of the current wave structure. If that's topping out, I'm looking for a 3-wave down consolidation. We've done one there. We've consolidated back up. Coming back down here, that's hit the trend line for an equal legs, and it's also a 38% pullback, shallow pullback. Right in the middle of that fair value gap. Ultimately, it could drop down here to the spot 618, where there's tons of support across there. I just think this keeps grinding higher. So our structure is right. I just underestimated just how powerful it really is. Stick with the Germans. A quick mention of oil. It's not in the weekly. I've not put it in this week, but we said we thought that there'd be everything left to have one last spurt up to the upside. And we've had a 1, a 3. We're consolidating. I think we've got the last tiny little bit left to put in this Y. We'll move that across now while we're here. The Y and B. All those there's lots of comments we got in today's weekly about the supply and demand. The OPEC and the Saudis are trying to make out that it's going to be in supply deficit for the rest of the year, and demand is much higher than they previously thought. But there's massive evidence at the moment that there's some light crudes that are going through Africa and Europe from the US going absolute supply crazy that are half the price of the incumbents, and that's causing all sorts of issues. So I think we're going to have this supply glut and price pressures which are just going to take over again, and it's inevitable that we're going to have the leg down. But it's done what we said. Quite happy with the analysis. Kept you in there. It's nearly time to start shorting this with the viewers. 83-ish, 82 spot, 88 it is for the equal legs. Might well be time to get a short on with that as a sort of stop area. So yeah, we're gold, our favourite. Everyone's asking where we're going, blah, blah, blah. No, I've been convinced that we're in some kind of consolidation for the last few days, and it worked for short-term short on Friday. What could have been the 3-wave down, which we mentioned before we got into this midweek and beyond connector issue, it looks like it isn't the 4th wave. I think we are doing a double. But there's every chance that happens today, until we take out this 2150, what's the low? 2150.46 low. We can't confirm really that we're in the downtrend. And again, at any point that could truncate, but for equal legs, and it'd be nice just to obey a couple of guidelines and rules short term, really build the momentum. I'd like to see it as do this, put in a double leg, ready for taking out a bit of time going into midweek, proper consolidation. Everyone's been waiting for it. Take a bit of the froth out, and then whoosh up to the upside. Because as mentioned earlier, ETF outflows, they reversed when the gold price moved. Probably seeing a bit of 2-way pull at the moment. Central banks, they've got miles to go. They're only at 20% reserves of what the historical 40% average is, and there's been much higher peaks than that. So there's tons of demand built up, and we've never had a more perfect set of super cycle and geopolitics scenarios in the background. If we can get rates behaving, that you've got the triumvirate and the holy trinity to get this thing up to mega highs. So it'd be good to see proper bit of price behavior. Just be careful, and then obviously we can start looking to buy into this dip the closer we get. But at the moment, as we said on Friday, until that low goes, it's pretty much no man's land, because if it holds that, then we've been doing a bit of nesting. So earnings wise, not masses around. Chinese-wise, we've got Tencent, which might give us a few clues what's going on in that space over there, if there's anything of note. NVIDIA have got a conference. Everyone's pent up for. They're probably not going to disappoint, are they? That could all coincide with risk on again. And Nike should be okay, following on from the Adidas trends we saw last week. Last week was slightly mixed tech-wise because you had Oracle beating by 12% and the smudged PDF of Adobe, which itself was down 12%. So we'd like to have a little bit more direction. We've talked about it's going to be dominated by central banks. Data-wise, US have got some housing stats. So is that more evidence of the underlying economy slowing? German ZEW, that's the financial advisors. Remember, they're bound to be upbeat. The DAX, as we've shown, is a powerhouse at the moment, going up. Confidence and outlook must be through the roof. Data's marginally positive. UK will see CPI and PPI prints, I think, before they have their meeting. So they'll be totally clued up there. Fed Wednesday night and Swiss Bank on Thursday morning also steps in. They're not expected to do anything. And then to end off the week, we've got UK consumer confidence, retail sales, and our old favourite Philly Fed, which normally has a couple of under the hood nuggets. Tons of stuff for you to look at from our memes and just my ramblings as we went on through the week, for just giving you ideas of how to look at data and the markets. Not going to go over that. And then you've got the diary at the bottom. So once again, good luck with all your trading out there. Bang the questions into me on the chat. And I've got a new setup coming. So hopefully this will all look slightly different next week. Take care.